It will come on investment, stock, trade, cash, and bank balance comes to current asset, whereas preliminary expenses will come under miscellaneous expenses and losses. 10 lakh, 11 lakh, increase of 1.50, increase or decrease look after. The totally 22 lakh, it will work 13.57%. Equity share capital plus preference share capital plus reserve plus profit minus preliminary expense. There is no preliminary expense. It worked to 3 lakh 60, 0.166. Hello, my dear students. I am Dr. B.S. Subramania, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Aid College, a Temple of Excellence, MYSURU. In this session, I am going to have Management Accounting 6th semester, Session 3, in favor of Model Question Paper 25 and 26. In the last session, I solved the problem for 2 marks, then 10 marks. Today, I am going to solve the problem for 15 marks. Shall we move on to problem now? From the following balance sheet of MMO Limited as on 31st March 2024 and 31st March 2025, prepare comparative statement of balance sheet. So liability, you have to compare increase or decrease. You have got equity share capital, you have got preference share capital, you have got debenture, reserve fund. So what's called the fund belongs to equity, preference, reserve, and profit and loss goes to in favor of shareholder. Regarding debenture and mortgage loan goes to a long-term loan. Then trade payable and current liabilities are called current liabilities. Then regarding fixed asset, the fixed assets are machinery, building, furniture, goodwill. It will come on investment, stock, trade, cash, and bank balance comes to current asset, whereas preliminary expenses will come under miscellaneous expenses and losses. We have to compare first liability side, then you have to go with asset side. Sources of funds. This is the heading on the liability side. Sources of funds. Then here. Number 1. Shareholders fund. Which are the years are 2023, 2024, increase or decrease amount, percentage. Sources of funds, shareholders fund. First, we'll go to equity share capital. We call this as number 1. Equity share capital you have to compare 2023, 2024. You have to see that it's an increase or decrease. How much you got? 10 lakh, 11 lakh 50,000. 10 lakh, 11 lakh 50,000. So equity share capital 10 lakh, 11 lakh 50,000. There is an increase of plus 1 lakh 50,000. So 10 lakh, 11 lakh 50, increase of 1 lakh 50,000. This is 150 followed by 30 divided by 10 lakh, 10 into 100. It works out 15%. This goes to equity share capital. Then we have got 8% preference share capital, 8% preference share capital. What's amount? 5 lakh, 5,50,000. 5 lakh, 5,50,000. So 5 lakh become 5,50,000. So there is an increase of 50,000. So 50,000 divided by 5 lakh into 100. So it works out 10%. So shareholders fund, equity preference, then reserve fund, reserve fund. What's the amount? Reserve fund 80,000, 90,000, 80,000, 90,000. There is an increase of 10,000. This is 10,000 divided by 80,000 into 100. It works out 12.5%. D. Profit and loss account. Profit and loss account 40,000, 50,000. Increase of 10,000. So 10,000 divided by 40,000, 25%. So this belongs to one group. So we can say this is reserve and surplus. We can say this one equity. And so we can, if you want, you can divide this as a source of fund. A, B, equity, all belongs to shareholders fund. So equity, preference share, reserve, profit and loss account. Then we have got loan. We have got a loan here. Long-term liabilities. Number 2. Long-term liabilities. Which are long-term liabilities are? One is 8% debenture. So first shareholders fund, equity, preference share capital, reserve, profit and loss account, one group. Then we have got long-term liabilities, debenture, 2 lakh, 2,10,000, 2 lakh, 2,10,000. Increase of 10,000. So 10,000 divided by 10,000 divided by 2 lakh into 100, 5%. Mortgage loan, mortgage loans, 1,50,000, 1,85,000. 1,50,000, 1,85,000. So there is an increase of 35,000. So 35,000 divided by 1,50,000 into 100. 23.33% mortgage loan, 23.33%. Then number 3, long-term liabilities, Current liabilities. Current liabilities. One is trade payable. Trade payable. Trade payable. What is trade payable? 80,000, 1 lakh. Trade payable, 80,000, 1 lakh. There is an increase of 20%. 20 divided by 80 lakh into 100. This is, you have got 25%. Then, what next you got? Current liabilities. Current liabilities, 1 lakh 60, 1 lakh 75. So, there is an increase of 15,000. So, 15,000 divided by 1,60,000 into 100. So, it works out 9 plus 9.375. Total of this, he has given the total. What's the total of the first year? 22,10,000. Second year, 25,10,000. 24, 25,10,000. So 22,10,000, 25,10,000. So there is an increase of 3 lakh. So 3 lakh divided by 22,10,000 into 100. It works out 13.574. Total. This goes in favor of liability side. We'll go to application of funds. Asset side. Application of funds here. Number 1, fixed assets. (2023), 2024, 2023, 2024 increase or decrease amount. Last one, percentage. We'll go. Fixed assets, plant and machinery, plant and machinery, plant and machinery, 5,50,000, 6,80,000, 5,50,000, 6,80,000. So there is an increase of 1,30,000 plus. So 1,30,000 divided by 5,50,000 into 100, 23.67, 636, 64, 23.67 64 percentage. B, land and building, land and buildings, 6,25,000, 6,45,000, 6,25,000, 6,45,000. There is an increase of 20,000. So 20,000 divided by 6,25,000 into 100, it works out 3 plus 3.2%. Land and building is over. What next? This over, this over. Next one, furniture. Furniture, 55,000, 70,000, 55,000, 70,000. So there is an increase of 15,000 furniture. So there is an increase of plus 15,000. So 15,000 divided by 55,000 into 100, 27.27. What next? Furniture. Next, goodwill. Goodwill. It works out 3,15,000. Then 3,70,000. 15 plus 5, 20. Then there is an increase of 55,000. 55,000 divided by 3,15,000 into 100. 17.46%. Goodwill. What next? So all over. Then investment. Investments, 80,000, 85,000. Increase of 5,000. 5,000 divided by 80,000 into 100, 6.25. 25%. Then we'll have current assets. In this A, what is it? Current asset, trade receivable. What is trade receivable? 1,05,000, 1,25,000. 1,05,000, 1,25,000. So there is an increase of 20,000. 20,000 divided by 105 into 100. 19 point, there is trade receivable, 1,05,000, 1,25,000. So there is increase of 20,000. 20,000 divided by 19.05. A, B. Stock 4,15,000, 4,50,000, 4,15,000, 4,50,000. So there is an increase of 35,000. So that there is stock 4,50,000, 4 lakh increase of 35,000. So 35,000 divided by 4,15,000 into 100, it works out 8.43%. Then we have got stock over trading. Cash. C. Cash 60,000, 80,000. Increase of 20,000. So 20,000, this is 20 divided by 60 into 100, 33.33%. 2023, 2024, increase, decrease, amount, percentage. 2 over, 3 over, 4th. Miscellaneous, expenses. In that, preliminary expenses, $5,000, no increase or decrease, no percentage. So totally 22,10,000. Then 25,10,000. Increase of plus 3 lakh. It works out 13.57%. So total application. Prepare comparative balance sheet. Hope you understand. Just shareholders fund which increase this, or we can divide this reserve and surplus. So 10 lakh, 11 lakh, increase of 1.50, increase or decrease look after. The totally 22 lakh, it will work 13.57%. Same thing goes to asset side. This goes to fixed assets, then investment, current assets, then miscellaneous, primary expense separate. No increase, no decrease. We'll move on to next problem. So this is the ratio analysis. The trading and profit and loss account and balance sheet of JKL Company Limited are given below. Trading and profit and loss account is given. Then this is opening stock, purchase, wages, gross profit, sale, closing stock. Then by gross profit brought down, this is by dividend and share, by profit on sale of share, by interest, all these items are there. So they will give the balance sheet. 1,20,000 goes to preference share capital, 1,40,000 goes to equity share capital, general reserve, profit and loss account. Then prepaid expenses. This is your cash at bank. This is goodwill, land and building, plant and machinery, stock, debtor, bills receivable, prepaid expenses, cash at bank. This will make the total. This is 0. So 22,000. We'll move on. Then from the above, calculate the following ratio. Gross profit ratio, operating ratio, net profit ratio, fixed asset turnover ratio, current ratio, debt equity ratio. We'll go one by one. Number 1, gross profit ratio this is formula GP divided by net sales into 100. This is formula. What's the formula? Gross profit divided net sale means total sale minus sales return into 100. What's your GP as per the problem? 3,20,000. This is your GP. What's your sales? 9 lakh. There is no sales return at all. 9 lakh into 100 percentage. So 3,20,000 divided by 9 lakh. 9 followed by 50 into 100. 35.55 percentage. This goes in favor of gross profit ratio. Number 2, net profit ratio. Formula. Net profit divided by net sales into 100. What's your net profit? 70,000. Your net sale is 9 lakh into 100. 70,000 divided by 9 lakh into 100. 7.77 percentage. Then what next you got? This over this over. Then operating ratio. Cost of goods sold plus operating expenses whole divided by net sales into 100. What's the formula? Cost of goods sold plus operating expenses divided by net sale into 100. Cost of goods sold. Sales minus GP. What's your sales? 9 lakh minus. Your GP is 3,20,000. Deduct 5,80,000. This goes to cost of goods sold plus operating expenses is equal to cost of goods sold. What is your cost of goods sold? Then operating expense is given. Cost of goods sold is cost 5,80,000 plus what's your operating expenses? 2 lakh plus selling expenses your selling expenses 28,000 divided by 9 lakh into 100. This is 5 lakh 80 plus 2 lakh, 7 lakh 80, 5 lakh 80 plus 2 lakh, 7 lakh 80 plus 28,000, 8 lakh 8,000 divided by 9 lakh into 100. 8 lakh 8,000 divided by 9 lakh into 100. 89.77%. This goes to operating ratio. This over fixed asset turnover ratio. Fixed asset turnover ratio is equal to sales divided by fixed assets. Current ratio dt. Sales divided by fixed asset. Fixed assets will go one by one. Which are the fixed assets are? Minus return of plus building plus machinery is equal to, what is your goodwill? 50,000 minus return of in P&L account, goodwill return of 4,000 plus building 1,80,000 plus machinery 60,000. Add. This is 46,000 plus 1,80,000 plus 60,000. So it will work out 46,000 plus 1,80,000 plus 60,000, 2,86,000. Apply now. Fixed asset turnover ratio sales 9 lakh divided by 2,86,000. Sales divided by fixed assets. 9 lakh divided by 2,86,000 is equal to 3.15 times. Turnover, no, you have to write times. In turnover, you have to write the times. What next? This over current ratio, current assets divided by current liabilities. Current assets is equal to current assets, stock, debtor, BR, stock plus debtors plus BR, stock, debtors, BR, prepaid expenses, plus bank. Come back here. Stock 1,20,000 plus 75,000. plus BR 40,000 plus prepaid expenses 3,000 plus 22,000. So which are the current assets are? Stock, debtor, BR, prepaid expenses, bank. Now apply this. 1,20,000 plus 75,000 plus 40,000 plus 3,000 plus 22,000, 2,60,000. Then current liabilities, you got creditor. So which are the current liabilities are? Creditor, BP, bank loan, provision for taxation and proposed dividend. But here we have got only creditors. Creditors is equal to 1,30,000. This is your creditors. Then current ratio is equal to current assets 2,60,000 divided by current liabilities 1,30,000. It is 2 is to 1. This goes to current ratio. What is the last one? Debt equity ratio. Debt equity ratio is equal to debt divided by equity. Debt is equal to long-term debt. Debt is equal to debentures. Only debentures are there. Debentures is equal to 60,000. Equity share capital plus preference share capital. Equity share capital plus preference share capital plus reserve profit and loss account. Is equal to, what's your equity share capital? 1,40,000 plus 1,20,000 plus reserve 30,000, P&L accounts 70,000. Add is equal to 1,40,000 plus 1,20,000 plus 1 lakh, 2,52,000. 1 lakh, 2,20,000, no. 140 plus 1,20,000, 2,60,000 plus 1 lakh, 3,60,000. So this is equal to debt divided by equity. What's your debt? Debenture is 60,000 divided by 3,60,000. So 60,000 divided by 360, 0.166 is to 1. 0.166 is to 1. This is a ratio. So we have solved all the ratio. GP ratio, GP divided by net sale into 100. NP ratio, net profit divided by net sale into 170. This is 7.7%. Then operating ratio, cost of goods sold plus operating expense with net sale into 100. Cost of goods sold, sales minus GP. Operating means operating expenses plus, this is 2 lakh. Cost of goods sold plus operating plus selling expense divided by 9 lakh. So it works out 89.75. Fixed asset turnover, sales divided by fixed assets. Sales is 9 lakh divided by 2 lakh, 3.15 times. Current ratio, current asset divided by current liability. Current assets are stock, debtor, prepaid expenses, bank, 1 lakh 20, 2 lakh 60. Current liability is a creditor, 1 lakh 30, 2 lakh 60 divided by 1 lakh 2.2 is to 1. Debt equity ratio, debt divided by equity. Debt means long term. Long term. 60,000 equity means equity share capital plus preference share capital plus reserve plus profit minus preliminary expense. There is no preliminary expense. It would go 3 lakh 60, 0.166. Hope you understand. We solved ratio analysis. We solved comparative balance sheet. We'll meet in next session with another 2 problems. One is cash flow statement. Another is theory, difference between management accounting and finance. Till then, goodbye. Meet in the next session.